In this video, I want to break down a few points that FHFA Bill Pulte was talking about in his interview in relation to Trump's bidding of Fannie and Freddie buying mortgage-backed securities with $200 billion to help with home affordability. So let's listen to President Trump's lapdog here.
Good ideas in Davos, and then we'll see from there what he wants to do.
Besides relying on the Fed, is there anything that your agency can do in terms of lowering mortgage rates?
Well, we're buying $200 billion worth of bonds, so that's a pretty big deal. I met with the team this morning. We put in a $3 billion buy already.
So they put in a $3 billion buy already. So the lapdog is already initiating this incentive of Fannie and Freddie to actually buy mortgage-backed securities. The president basically told them to do it. So let's talk about what that really means for interest rates and how this political lapdog actually might make some things work within the home affordability outline. So Mr. Pulte did announce that the president is going to announce some initiatives next week in Davos. And Mr. Pulte is out doing interviews saying Fannie and Freddie have ample liquidity, and they're already executing the president's order to buy the mortgage bonds. So the sales pitch is kind of simple. President says, buy, and that's essentially what they're doing. Now, what does that actually mean for the average consumer? Because this headline sounds great, right? Basically, let's go through some of the mechanics. In plain English, the government is telling the agencies to step up the bond buying process, and they now are the big giant in the room, just like the Federal Reserve was back in the time of COVID, right? So price incentivizes the buyer. So when a big buyer shows up to buy all of the mortgage-backed securities, that pushes MBS prices up and their yields down, and eventually that can translate into slightly lower rates. Here's the thing. I was speaking with some of the people that I know in the industry, and I was questioning whether or not $200 billion would actually move the markets. And through a few of my using AI and also talking to some economists, we came to a conclusion that $200 billion, while marginal impact, could have a greater impact now than we might think. So back in the times of QE and the Fed buying $1 trillion worth of bonds, essentially that was about a 75 basis points to a 1% move in the market. AI said that they could expect that the benefit of $200 billion would be maybe 10 to 40 basis points. And then I started to think about it, and I was talking with some friends that are very knowledgeable on mortgage-backed securities, and a few of them had traded them in their career, and they went into talking about supply and demand. So a thought process that we had was that while $1 trillion with the Fed moved it 75 to 100 basis points, that was in a time when interest rates were decreasing and the supply and demand was greater than it is now. So there was a lot of mortgages being done on an annualized basis. And so buying $1 trillion was not as a percentage as great as $200 billion might be in a time when mortgages are not being done as rapidly, right? So what I'm trying to get at is supply and demand. There's less mortgages out there for them to buy. Therefore, 200 billion is going to go further than maybe what a trillion did during that time frame. So we're kind of thinking that that should add maybe an extra 10 basis points, maybe an extra 20 basis points. So maybe a range between 30 and 60 potentially on the movement of buying 200 billion. Now, it could be short-lived, but if you think about it, Fannie and Freddie have the ability to borrow essentially from the Fed at extremely low interest rates, and they can leverage that portfolio also. So you could maybe see that 200 billion actually be leveraged to be a little bit more if they get creative. So in my opinion, I'm extremely excited about hearing what the president actually might roll out in Davos. So from a pure macro standpoint, 200 billion deployed in a low liquidity market probably could move the needle just a little bit further than what some of us are expecting. Them just talking about it brought the average rates down into the high fives instead of the low sixes. So in closing, I do think that this could be the start of some great things to come if the president is truly putting forth an effort on homes affordability and the ability for them to potentially stop institutional buying of homes from corporations. While that might only be about 3% of the purchases in a year, that does multiply over time. So 3% this year, 3% next year, 3% the next year. If they stop that, that's an extra 9% potential homes that could be bought over a 2 or 3 year period while the president's in office. So I'm extremely excited about some of these changes that's going to potentially be happening as early as next week. So my name is Kevin Retcher, owner of First Meridian Mortgage. This is The Till, which is truth in lending and in life. I'm a mortgage broker in Virginia, Maryland, and D.C. I specialize in no closing cost refinances. I've been doing them since 1996. So here's the thing. If you're in the market for a refinance, I would be my pleasure to help you in Virginia, Maryland, D.C. I have 32 other states covered. I might be able to actually refer you to somebody that I know that's another broker owner just like me in another state. So feel free to give me a call, run through your scenario, and try to help you with a no-cost refi. If you've bought in the last 3 years, you're probably in the money. I locked a number of clients in at 5.999 with no closing cost, and people that wanted to pay closing costs actually saw 5.625s on VA loans. I sub 5.5. So if you're in the sixes or higher on a VA loan, you should absolutely do a VA IRRRL. Again, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage and the sole originator. So you will be doing business with me, licensed or signed up with over 30 different investors. I look forward to saving you money. It's one of my primary goals. Give me a call. I'll talk to you soon.